Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Bernard Reisz. Bernard is with ReSure Financial, and he is a licensed CPA, and he is an expert in different real estate adventures and all the different complexities that come when you try to structure the entities or use your investment assets or 401k into investing in real estate, whether that's syndications or joint ventures and things like that. When it comes to such investments, Bernard helps clients set up the self-directed IRAs or the checkbook IRAs or even the QRPs, right? And today we are going to delve into details about what it takes to set it up, the tax consequences, and all the details that come with it. So thank you for taking time, Bernard. I appreciate it.
Sakar, thank you for having me on. I'm looking forward to the discussion. It's one of my favorite topics, is self-directed retirement accounts, whether we're talking QRP or IRA based. And it definitely integrates very nicely with some of the other things that you mentioned, very closely related to entity structuring, even 1031 exchanges inside of retirement accounts.
Awesome.
So there's lots of fascinating permutations. So let's dive in.
Awesome. So, Bernard, before we delve into, I want to, maybe have a disclosure as well. This is a very wide topic wherein I think I want to encourage listeners to, listen to the podcast, but at the same time, understand the complexities that come with it. This is not a one bullet solution for everything. So I want to definitely have that caveat and maybe perhaps have listeners contact you or, consult a proper consultation over this and go over their individual solution, right? So with that, Bernard, help us get started with your background, what all the different services your company does, and how you kind of came about into this whole space, and what sort of is your passion in general over this topic.
So my background is a CPA, and that includes due diligence and sophisticated tax strategy.
Sure.
My particular passion lies in tax and financial strategy, and particularly going really deep into specific subjects. So I mean, really going through the tax code, the tax regulations, revenue rulings, and case law. So really in a substantive way, taking a deep dive, which lets you know the black, the white, and the gray.
Sure.
Sometimes people think, oh, in tax, you can do whatever you want because you can always interpret it this way or that way.
Sure.
There is a lot of gray in tax, but there's also black and white. So it's very important to be able to know where the black is, where the gray is, where the white is, and all the shades of those gray.
Sure.
So that is my passion, primarily tax.
Awesome. So now, Bernard, let's go through basics as to, someone has a 401k, right? And they are willing to invest, right? And as we all know, 401ks carry a majority of investments of somebody rather than, having a lot more liquid capital. 401k becomes a gold source of your sort of piggy bank where you would want to invest. We all know that investing in syndications can be extremely profitable as if it is done the right way in the right markets with the right operators and things like that, right? So given that, I have personally seen that there's a lot more demand from a lot of passive investors to know that, okay, I have, like millions of dollars locked inside my 401k. What are different steps you can advise, or what are some of the baby steps someone can take towards, trying to understand this space?
Yes, that's a great question. And before we talk about technical tax and labor law aspects of it, I think I want to say, advise people that then not to be intimidated by anything that we discuss in this space.
Sure.
So as somebody that specializes in this and as a CPA that reads that tax code and tax law, I feel very, very strongly that this is something that everybody should be doing and considering. If you have discovered real estate and you believe in real estate and you see the risk-adjusted returns in real estate that they can provide to you and the diversification benefit, then you should definitely explore this. None of the technical stuff, all that is easily addressed with the right expertise and the right hand-holding.
Sure.
So that's one point that I want to make. So we're going to talk some technical stuff perhaps, but with the right service provider, it's not something that anybody has to sweat.
Right. I couldn't agree more, Bernard. And here is where the irony is. Like, I personally worked with a large mutual fund and financial firm. This is one of the top 5 or top 7 we are talking about, right? And I had never heard about self-directed IRAs or QRPs or IRA checkbook, right? And the only reason perhaps was that wasn't their core sort of expertise or, the services that they would advertise, right? They would sure tell you the IRAs that are available, but the self-directed part, certainly the solo 401k or perhaps the IRA checkbook or even the QRP, I never knew. But when I started to, look into passive investments and how are the different ways someone can, invest, my mind personally was blown. And this is where it became a passion of mine. I said, okay, I am a person who has been employed with a top 7 financial firm doing, retirement accounts, mutual fund accounts, and IRAs and things like that. And if I was not knowledgeable about this, think about, sort of the rest of the 99.9% of the population who is almost blinded by, okay, the 401k is there, but they do not know the different avenues that they can take to unlock the power and, sort of gain benefits and for their family and things like that. So that's something I wanted to, sort of say. And as well, then I kind of went and sought experts like you that, hey, could you please come on and explain? And obviously the topic is complex enough that, we can sort of piece by piece break this down. So take it away, Bernard, that, what are the different, at a high level, what are the different options available for somebody who just has a 401k but looking to, invest? What are some of the steps someone can take in this?
So chronologically, the first thing they have to, even before having a discussion with somebody like myself, they want to confirm that they can actually get their money out of the 401k plan.
Sure.
Because the tax code imposes limitations on getting money out of plans, and employers' plans can be even more restrictive than the IRS. The IRS allows them to do that to a great extent. So first is find out, can you actually get that money out?
Sure. So if I may, Bernard, there, are you maybe referring to the vesting period and things like that, that sometimes employers have those restrictions that, hey, you have to keep it for a minimum of 5 years, and that's when you could, do the transfers and things like that. Is that what you're alluding to perhaps?
So vesting is certainly a factor, but even in assets that you are 100% vested in, there are certain components of that the tax code says you cannot take out of the plan while you are in service. So as long as you're working with that employer, you cannot take certain money out. There are certain types of in-service distributions that you can do. So of course, had you rolled money into the plan, say you switch jobs and you roll money from one 401k to a new 401k, you'd probably be able to get that money out. But deferrals that you made and safe harbor contributions from the employer side, you probably have to wait till you leave. Although now with coronavirus and the CARES Act, there are opportunities to get money out because there's something called a coronavirus related distribution. So people right now, for the remainder of 2020, there is a window of opportunity to get money out of 401k plans. And, come December 31st, 2020, those are going back under lock and key. But between now and then, there is an opportunity to get money out of there tax-free and then put it into your own retirement plan, paying no taxes.
Sure. Now, a couple of things, Bernard. One is how much money can they take out? And secondly, the limitation that you described wherein, they cannot take the money out and things like that. What would be, what steps someone can do to find out, is that calling the customer service, or is there any specific section within their account they can go and check as to what sort of stipulations they are bound to by this?
So we have a great resource for this. And we find people have to be a little persistent. And a lot of it comes back to also what you spoke about before with the mutual funds and 401k plans. What happens today, what has happened historically, anybody can just go out and Google 401k litigation. Which is 401k money was a bit of a slush fund for investment firms. All sorts of fees are being pulled out by all plan service providers and the investment advisors. And so when very often the way a company ends up with a plan is because a stockbroker will come to the business owner and say, hey, provide this plan to your employees. It'll make them happy. You got to provide a 401k plan today. You can get some tax deductions for yourself to set up a 401k plan. Now, the motivation of the stockbroker or financial salesperson is he just wants to get the assets to collect fees off, right? And so then they're going to bring in a document provider, somebody that actually puts together the plan paperwork. And usually that plan paperwork is going to place additional limitations or be as restrictive as possible to keep people from getting money out, because everybody is profiting from keeping the money in that pot. There are a lot of hands in that cookie jar. So you have to be a little persistent, and it's just too easy sometimes for the plan administrator to say, oh, you can't take the money out. So we give people a resource that says, hey, this is the information that you need. This is the question that you have to ask. These are documentation that you can look at. Be persistent until you get a clear answer from somebody that actually knows. But assume we get past this point and they can actually get the money out, or maybe they're between jobs, or they're in a period right now where lots of people are between jobs, and they can pull money out of a 401k plan. So the next step is going to be identifying what kind of account is going to be best matched to them for their personal private real estate investing.
Sure. And that implies that basically different types that are available, right? Could you maybe go into that, Bernard, as to what different types or what factors play into all that?
So broadly speaking, there are two account categories. That's how this is how I like to set up the framework.
Sure.
Within those two account categories, there are technically millions of ways plans can be structured. But broadly speaking, we're talking about some sort of IRA-based route or QRP-based route.
Sure.
So these are two distinct types of plans. IRAs are much, in a sense, simpler. They come in many flavors. So an IRA can be traditional IRA, a Roth IRA, SEP IRA, simple IRA. But overall, IRAs are more straightforward than QRPs.
Sure. Now, what is a QRP? I mean, a lot of folks know IRAs and Roth IRA. I mean, the buzz or the, all the keywords have been out there that, okay, Roth, I don't pay taxes on it. It's all deferred and things like that, right? But what is a QRP? What does it stand for, and why it is a central distinction piece between IRAs and a QRP?
So QRP is the most there is so much misinformation out there. And daily I'm speaking to people every day. A day does not pass with people that are misinformed about QRP. So QRP stands for Qualified Retirement Plan. That's all it stands for.
Sure.
Now, QRP is just easier to say QRP than Qualified Retirement Plan.
Sure.
Just like it's easier to say IRA than Individual Retirement Arrangement.
Sure.
So QRPs come in many, many flavors, but they do have much more tax flexibility, which comes along with a lot more administrative burden and administrative compliance and potential liability penalties. So it's always in life, as a general rule,
Sure.
Opportunity goes hand in hand with responsibility.
Sure. Now, Bernard, getting back to the basics of it, right? So what makes a QRP or a retirement plan a QRP, like a qualified retirement plan? What is sort of the underlying difference between sort of an IRA or a QRP?
So a qualified retirement plan is a retirement plan that meets all the requirements of the tax code for qualified retirement plans, both in documentation and operation. So there are a lot of rules that go along with that. But the basic premise, distinction between a QRP at the most fundamental level, breaking it down to the most elementary level, is that an IRA is a trust established for the benefit of an individual. And a qualified retirement plan is a trust established for the benefit of employees.
Interesting.
So that's the fundamental difference, is one is established for an individual and one is established for employees. And that's why you get all the complexity, because being that it's established, the concept is it's being established for the benefit of somebody else, right? The business is establishing it for the benefit of the employees. Therefore, the IRS and Department of Labor are very concerned and have to make sure employees are protected. That's where the complexity really emerges from. Now, one thing that you haven't brought up, which is solo 401k.
Sure.
Where does that fit?
Right.
So solo 401k is a plan that belongs to the QRP section of tax code, but without the complexity.
Interesting. So you are saying the compliance and all the other sort of reporting requirements that apparently are within the QRP, they are simplified, or they do not exist for the solo 401k side of the house. Is that kind of what you're referring to?
That's exactly it. And I think it's a mistake to say kind of the QRP. There's no such thing as the QRP. There are qualified retirement plans which come in many flavors. The real estate industry now recently has kind of been introduced to this term, and I speak to people every day that think there is something called the QRP, some sort of new concept. When we say QRP, if you had a 401k at work, do you know what you had?
Sure.
You had a QRP.
Interesting.
That is a QRP. Every 401k plan that anybody has had at work is a QRP. If anybody has had a pension plan at work, that means a defined benefit plan, which you see far fewer of today, you have had a QRP. Those are all qualified retirement plans. Now, you may have had a safe harbor 401k, if you're familiar with that term, right? Or you may have had what's called a new comparability, or some sort of target date or age weighted. These are all different tweaks or different forms of
Sure.
QRP. QRP includes millions of structures, literally.
Sure.
What's been novel in the real estate space is that people have been using this terminology, thinking it's something new, which qualified retirement plan is actually the 401k plan that you're running away from is a QRP.
I see. Now, let's go through some of the sort of the the factors or what things someone can look at if they want to start using their 401k for passive investments, basically.
So, and I guess we're talking real estate as an LP.
Correct.
Yeah. So let's speak about real estate. Right. One of the things we'll talk to people about is what kind of investments you're planning to do. Now, within the real estate space specifically, there is a benefit to using a QRP. And again, QRP includes solo 401k. It includes a 401k that has many participants.
Sure.
Any type of QRP has certain very specific benefits when it comes to passive real estate investing. So the biggest one is that there is a very specific exemption for UDFI for qualified retirement plans.
Sure. For folks who don't know UDFI and the tax implications that come with it, could you maybe perhaps just elaborate on that, Bernard?
Yeah, glad to. So the way I like to do this, and we can do this as a bit of an exercise. What would you say is say your retirement account want to buy a house. Let's put syndication aside for a moment.
Sure.
Right. You've got $100,000 in your retirement account, and you're going to move it into a self-directed account. We don't know yet what type of account it's going to be. It may be IRA based, maybe 401k based, QRP. Now you get the money. You're going to put a down payment. You find an asset. You have two assets you can buy. You've got a $100,000 asset. And you've got a $400,000 asset.
Sure.
Now, being that we're talking real estate here, you can actually get a loan from a bank. They'll give you money. Suppose they'll give you $75,000, 75%, right? So the bank will give you another $300,000.
Sure.
Would you choose to buy the $100,000 asset with your retirement account, all cash, or would you buy the $400,000 asset using leverage? What would you choose?
Sure. Well, I mean, as far as, if I were to kind of answer that, right, you have the prohibited transactions or the self-dealing aspects of it, right? And that's where I think the nuances come in. From what I understand, you cannot personally buy, like, let's say a second investment house that, typically maybe you can invest, but you cannot take the proceeds from it directly. Everything has to play within that 401k realm, meaning, let's say if you're using 401k to, put a down payment and, let's say rent out your vacation rental or a second home of sorts, right? That all those proceeds have to kind of play within the 401k space, meaning it cannot go into your personal bank account and things of that nature, right? And now I believe there is also a section where you can have a hardship or clauses where, okay, I want to buy a house. So, I have heard limits where you can take out $50,000 and things of that nature. So there are, I believe there are some, provisions where you can, like, let's say you have a wedding in the house, or you're buying a house, as you said, or education. Those are all sort of, I think, nuances or provisions where you can, I think, withdraw some funds. But I don't know the enough details regarding that. I mean, I don't know if that makes sense, Bernard.
So what you're describing is taking money out of the retirement account to buy a personal residence, right? So when normally if you take money out of a retirement account, you have to pay income taxes plus a penalty.
Sure.
But if you're a first-time home buyer or certain education expenses, you can get the money out, but only pay income tax, no 10% penalty.
I see.
What we're describing is within the retirement account, rather than buying mutual funds, buying a property, an investment property, which is essentially what a syndication does. It just gives it to you almost like a mutual fund, and it gives you greater scales. When you use a syndication rather than buying a single family, you're able to buy a much more attractive asset class and have it totally managed by the operator and the syndicator. But I think just to illustrate kind of how it works and the mechanics of it, it's easier to use a single family house. So say somebody has the $100,000 and they're going to use it to buy a piece of real estate, single family, duplex, triplex, within their retirement account. And they can either do an all cash purchase for $100,000 or do a $400,000 purchase, getting a loan from the bank. If you were the investor, which would you do?
Right. Well, I mean, it sounds like $100,000 probably is a sure bet, right? I mean, you can buy it and, own it all within the IRA. Does that make sense?
And you can also own the $400,000 asset all within the IRA, because the IRA can borrow $300,000, as can the 401k. So given the opportunity, right, you're running your IRA. Now it's self-directed. You came to ReSure Financial. We set it up. You've got the money in a bank account, and now you've got a choice. I've got $100,000. Should I buy the $100,000 asset, all cash, or the $400,000 asset using $300,000 of borrowed money? The logical answer for every real estate investor is use the leverage. That's the beauty of real estate.
Sure.
Right? That you can get the bank's money and you get the benefit of leverage.
I see.
Right? Now the question is going to be, okay, you put in $100,000 equity from your retirement account.
Sure.
But you got another $300,000 from the bank, which didn't come from retirement account contributions.
Correct.
Retirement account earnings are tax-free. How about the earnings on this investment? You bought a $400,000 asset. You only put in your retirement account only put in 25% equity. 75% came from the bank. So is all of this tax-free, or is only the return on the equity tax-free?
I see. So that's where, Bernard, we always talk about that the tax liability that comes with the levered portion of this, meaning the 100,000 may be the tax-free, but the gains that you would probably get on the levered part, which is the $300,000 part here, right? That's where I think the distinction, or that's where the sort of the nuances of this tax liabilities come in. Go ahead, clarify on that, please.
That's exactly it. So here is where we have a distinction between QRPs and IRAs. In an IRA, the levered portion is taxable. The equity portion remains tax-free.
I see.
In a QRP, there's a special real estate exception for QRPs that lets you get the entire return tax-free. So when you talk about the benefits of QRP versus IRA, that is a big one. That's a very big one.
Absolutely. But then related question there, Bernard, is that why would someone do a self-directed IRA, right? Because you are obviously, the portion of your investment is obviously tax-free, but not the other levered piece of it, right? What would be the considerations, for doing a self-directed or perhaps a QRP for that matter?
So the analysis is understanding, firstly, the first step is, can this person have a qualified retirement plan? And what we see a lot out there is people have a piece of paper that says on it, XYZ company qualified retirement plan, QRP, but having that piece of paper does not make it a qualified retirement plan. What makes something a qualified retirement plan is if it meets the definitions of the tax code. So from the get-go, the first question is, can this be something that is treated as a trust created for employees? Are there any employees, right? Or the tax code has a section that defines when a self-employed person can have a qualified retirement plan, a QRP. So do you meet the definition of self-employed individual,
Mm-hmm.
or is there an employee? And many people have gone up and set up QRP,
Mm-hmm.
but they don't have a QRP.
I see.
They actually have a piece of paper that says QRP,
Mm-hmm.
but if the IRS were to audit them,
Mm-hmm.
the IRS would say, this is not a QRP.
That wouldn't meet the muster of all the requirements needed.
Exactly. So if somebody there's a huge risk in setting up a QRP when you don't meet the definition. So of course, if you never get audited, you can get away with it.
Sure.
But it's important for people to understand that if you don't clearly have a business that falls within the definition of what the tax code provides, you're taking risk. And does any of this come as a surprise to you?
Sure. I mean, ignorance sometimes can be pretty dangerous, right? I mean, like the solution sometimes that's proposed or that's, a lot of time gets advertised about, as you alluded to, right? I mean, it has to meet all the requirements, and you could as well sometimes say that, oh, that looks like a ship, but is that really a ship? Does it meet the requirements of the ship? And as you said that, well, if it is just not compliant enough, it may not meet those requirements, right? So going back to the question, Bernard, there, right? So are you saying that there are certain things that within QRP that need to be there so that it is a qualified, or the sort of the section of IRS that where you said wherein that the levered portion, the taxes that come with it are also tax-free for the QRP owners? Again, just clarify on that, please.
Yes. So it's a very specific exemption for what the tax code calls real estate acquisition indebtedness. So if something falls into that definition, there is an exemption. When there are partnerships involved, the exemption does not always apply. And now every syndication is a partnership.
Absolutely.
So you can technically have a syndication that is creating UDFI depending on how it is structured. But in most scenarios, it will be exempt. But what we're seeing again is a lot of people are making choices about having a QRP because they're running from the UDFI. But if they were to, somebody may have rolled over $1 million, right? And when they understand how UDFI works, and then you're saying, okay, on the one hand, I can have UDFI in an IRA-based account, or I can have a QRP, but it may not be a QRP. And if somebody says that this is not a QRP, that full $1 million,
it's suddenly exposed, basically, you're saying.
And then if it's found out a few years later, right, then all of a sudden it's penalties, interest, because that should have been on your tax return, on the tax return in that year. Right. Because when you take money out of your company 401k plan, right, you're doing a rollover. You tell the IRS, oh, no tax on this because I rolled it over to another qualified retirement plan. But if it was rolled over to a plan that is not, in fact, a qualified retirement plan, it's all taxable.
I see. Then I guess the common question, or a natural question that probably begs, is that what are some of the best practices? Like, let's say if someone is, like working, has a W-2, probably doesn't know much about the, setting this up. How can they go about this?
There's the only way to go about it is to work with somebody that has the expertise, so has the information that they need, and also has the integrity to tell them what you can or can't do. And sometimes solutions can be crafted. Sometimes, okay, we can come up with something. All right, this could work. We can set you up this type of plan. At the best case scenario, they're making an educated choice. So they understand that, okay, there's this pros and cons, and they're going to make the best choice. But what I important to bring home to people is that any type of account is going to be good. The question is, what is best for you? So I see people that find out about UDFI saying, okay, I'm never going to use an IRA for real estate, which is a very, very big mistake because real estate provides incredible benefits. Again, the risk-adjusted returns, the diversification, it's just phenomenal. Right. And remember, your equity portion remains tax-free.
Sure.
Right. If you had the choice, say, okay, I've got my $100,000 at Fidelity, and you get them, you say, listen, I've got $100,000 in the account. Can I please have $400,000 of mutual funds? Is that going to happen?
It doesn't work like that, right? Absolutely. That's the major difference right there, right? But then let's shift gears a little bit, right? We always talk about the checkbook power of IRAs and stuff like that, right? Explain us, like, what does that mean? Or sometimes people say checkbook IRA, like, you know, what is all that?
Okay, so here's another distinction again between qualified retirement plan, QRP, and IRA. An IRA has to have a financial institution custodian.
I see.
A qualified retirement plan does not have to have a financial institution custodian. Now, maybe we'll get a little into that, the nuances of that.
Sure.
But from the get-go, so the question then begins, if somebody has a qualified retirement plan, they can be set up with the money in a bank account. Very convenient. How do you achieve that with an IRA? How do you get the checkbook into the hands of the investor so they can have direct control over their money, total freedom, and also save a lot of money on fees and get rid of a lot of paperwork?
I see.
So that's what Checkbook IRA refers to. And the way that's done is by creating a business entity and telling the IRA custodian, hey, we're doing a private equity investment. Now, it's going to be a newly created company that has specifically created and structured so that the IRA custodian will review it and say, okay, we can fund this company. And they're going to move the money into that company. And who will control the company? That will be the investor. So this way, even an IRA, we get the control of the money into the hands of the investor.
I see. So basically, you are introducing an entity and that entity basically, or the beneficiary of that entity is basically the 401k account itself or the IRA account itself, right? But the owner, or let's say the employee or the W-2 person here we are discussing, is really the one who gets the checkbook control over it. So essentially, when they are investing into other syndications and things like that, it's really that entity that's created is what is going on and investing into those syndications. Did I get that right, by the way?
That's exactly it. Hit the nail on the head, Sekar.
I see. And that is so are there any limitations as to is that going to be like an LLC or a trust, or are there any best practices regarding how you go about setting that up or not?
There are multiple layers of best practices. LLCs and trusts are both out there. And we assist people and can assist people with either of them. However, when it comes to trusts, we think there's a lot of downside to using a trust, It's almost, to be perfectly honest, we offer it because we always want to remain objective. We want to tell people, you can work with us because whatever is out there, we can set it up for you. You want QRP? We can do that. You want solo 401k? We can do that. You want IRA trust? We can do it. IRA LLC? We can do it. But by the time we're finished educating people, they're probably going to choose to use an LLC over a trust. And trust excites people. It sounds more novel. We see a lot of potential downside to using a trust.
I see. Interesting. Thank you. So the idea would be here is that you set up the LLC and set up the qualified retirement plan as such, right? And that's when you will establish the bank account for that entity, and that's where the money will move in, and the investor or the person owning the IRA gets the control, and that's how he's doing it. I guess. Good. Thank you. I appreciate it. What are some of the other sort of nuances into this, Bernard, that someone should be knowledgeable about?
What I'd say is it's really about doing due diligence. Ultimately, it's not a do-it-yourself project.
Sure.
The internet has good information and bad information about this topic, just
Sure.
like it does on every topic.
Sure.
So people should do due diligence. When choosing to work with somebody, they should find out if does that person have the technical background and expertise and integrity to work with them. What has happened in this space is 99 out of 100 providers in this space, if there are that many
Sure.
providers, are primarily in the business of selling you a piece of paper. And you get control, but you may or may not have the plan that really suits you from a tax perspective. So you need somebody to work with somebody that will give you the guidance and has the expertise to help you weigh your options.
I see. Thank you. And also, Bernard, that you mentioned earlier that QRP comes with the reporting and the compliance aspects of these things, right? So explain us that, what compliance things that we should be looking for on a sort of an annual basis, or if there are any other reporting, requirements that need to be done around QRPs.
So when we talk QRP, let's for purpose of our discussion, we'll restrict it to 401k plans.
Sure.
So when we're talking solo 401k and something that really qualifies as a solo 401k, there's very limited reporting requirements. There will be a Form 5500 EZ required once plan assets are worth $250,000. Other than that, there's not much annual reporting compliance. The plan documents have to be maintained and updated, right? The IRS is always changing the rules, and so the plan documents have to be updated, but the reporting is really minimal.
Straightforward. Got it.
But once we go into the space of a qualified retirement plan that does not fall into the solo realm, then all of a sudden your compliance went through the roof.
I see.
So the first thing is you have to understand that every single qualified retirement plan has to file a Form 5500 once it's not solo, even if it has $1 of assets. Now, you cannot file Form 5500 EZ, which is the easy one.
Sure.
You have to file either what's called 5500 SF or the full 5500. If you're going to have real estate in there, private real estate investments, you have to do the full 5500. And full 5500 also opens you up to liability because you have to tell the IRS and the Department of Labor, I have this, I have that. Did we do an appraisal? Did we not do an appraisal?
I see.
And then you've got to have a fidelity bond. Once you have employees, it's not a solo plan, you need a fidelity bond. If you have non-qualifying assets like private real estate, you have to increase the value of the fidelity bond. And then you also have to, there's a world of liability and testing. So you have to make sure what happens if the owners of the company are getting more benefit from the plan than the employees.
I see.
All sorts of penalties. If you're giving yourself access, you're the business owner, and you're doing private real estate investments, you have to give all your employees the same option. So the same possibilities. So you can look up, if you really run a qualified retirement plan as it should be, there's no way that it's going to cost, more than, it's got to cost a few $1,000s per year. Now, there are people out there that say they're giving you a QRP, but they're giving paperwork. They're not doing the compliance or administration. You're getting a, piece of paper.
Interesting. Thank you, Bernard. I mean, this is a topic, as we discussed earlier, that we can definitely do multi-part series into it and kind of step-by-step cover different aspects into it. So unfortunately, we are just about time for the show. So I definitely appreciate, your expertise into this. Please tell our listeners, Bernard, as to, where they can go, how they can reach you, or maybe a few resources where they can read more about this as well.
So sometimes I say just Google Bernard Reisz, ReSure Financial, ReSure LLC. You'll find lots of great resources. Specifically, if you want to visit us, there's 401kcheckbook.com, which is totally devoted to retirement accounts and private investments. And you can find there, lots of resources there. Then we've got agentfinancial.com, which kind of addresses all sorts of other real estate tax topics. So that's where we do for tax strategy, 1031, installment sales, entity structuring. That all goes through agentfinancial.com.
Awesome. Thank you for your expertise, Bernard. And as we shared earlier, that this is a wide-ranging topic. So listeners are encouraged to consult expert like Bernard and get into the details of what's needed. I think just a simple podcast is not enough to cover all the nuances that come with this. So it's been a pleasure, Bernard. I appreciate you sharing your expertise with us. I hope to have you again back on a future episode where we can delve into a lot more details around this. So thank you for your time today.
Sekar, thank you for having me. I really enjoy sharing this knowledge, and I loved our discussion.
Absolutely. Absolutely. Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.